Hello, everyone, and welcome to Dividend Compounders with Cheese. Today, we're going to be taking a look at Texas Roadhouse, ticker symbol TXRH, to see if I had $500, would I invest in Texas Roadhouse? So, Texas Roadhouse is actually trading right now at around its 52-week low. $90 is when it hit its bare bottom, and it's currently trading at about $92, but it keeps fluctuating back and forth around $90 to $92. So if you're thinking about getting into Texas Roadhouse, right now might be a good or a bad time. And because this is a channel that cherishes and adores dividends, let's look at the overview real quick. So the dividend yield right now is a very healthy 2.39%, which means for every share of Texas Roadhouse that you have, you get paid $2.20 in dividends, a payout ratio of 50.93%. So far, so good. Everything looks healthy. However, there's always more to the picture than just the dividends. So in this video, we are going to look at the intangibles, the finances, and run some valuation models to determine if I have $500, am I going to buy Texas Roadhouse? So the first thing that I like to do when I investigate and research a company is to look at its historical PE ratio. Because although the PE ratio doesn't tell a full story, it kind of gives you an idea of whether or not the valuation is fair or consistent with its past. And past performance is not indicative of future gains. But anyways, as of today, Texas Roadhouse has a PE ratio of about 21.2. Now, if we look at its history, back in 2010, the Texas Roadhouse stock was trading at about $11 with a PE ratio of 14.8. If you bought it for about $11 or so right here, about $11, just to look at the gains, that's about a 900% gain in 13 years. But regardless, let's fast forward and look at what's going on. It looks like the PE ratio hovered around 15 to about 20. And then as we entered 2016, the PE ratio started to go up to 25, 27, as it turns out that Texas Roadhouse is indeed a growth company. And then during the pandemic, of course, the PE ratio surged to 165 because everyone's revenue was just all wonky during the lockdowns. But if we were to zoom in and look at the PE ratio prior to the pandemic, it looks like back in 2018, Texas Roadhouse was trading at about, what would you say, like a 22 to a 25. So I would say that Texas Roadhouse is indeed trading at about its historical PE ratio. The next thing that I like to do is look at the current events and look at any news surrounding the company. Now, I thought this was pretty startling because this was just released. It is a market research conducted by Savanta. Savanta is a market research company that conducted surveys from over 72,000 consumers on eating out to see which restaurant brands they loved the most. And Texas Roadhouse was actually number 4 overall out of all the different food and restaurant and drink brands in the US. The only 3 companies to beat it were Chick-fil-A, also known for their awesome customer service, Starbucks, and McDonald's. However, what is very unique to Texas Roadhouse is that it was the number 1 most cherished sit-down restaurant chain. This is the first one. The next one is going to be Olive Garden at number 6. So Texas Roadhouse, Olive Garden, and then if you zoom over here, Cheesecake Factory was number 3. So Texas Roadhouse takes the crown. I myself am biased towards Cracker Barrel, but I can definitely see how and why Texas Roadhouse is so loved. If you've ever visited a Texas Roadhouse before, you know that their dinner rolls with that cinnamon butter, my goodness gracious. So right here, a different category that they won number 1 is out of all the different steak restaurants, they got number 1. However, I don't think it's fair to just categorize them as a steakhouse because their menu, literally, every time I eat there, each person pays like $8 to maybe like $11. Whereas a traditional steakhouse, you're paying upwards of $20 to $25 per person. So they got number 1 in the steak category because I think it's really cost effective, but also delicious. But here is my beloved Cracker Barrel. They got number 1 out of all the family style restaurants. Moving right along, we want to take a look at the shares outstanding. And for our case and purpose, let's look at the past 5 years. It does look like the shares outstanding are declining. And as of right now, we're sitting at around 60 million shares. And the reason why shares outstanding is a metric that I value is because we want to find out if the company is issuing more stocks and diluting the shareholders, or are they buying back shares? Because buying it back is actually a good thing. Because if there's less shares outstanding, that means each share that you own has quality over quantity. And in the case and an example of Texas Roadhouse, it does look like they're buying them back, but at a very slow pace. It almost seems like their board of directors and company leadership like to have the shares outstanding hover around 70 million. So when it comes to Texas Roadhouse, so far so good. But hang on, because we're going to have to run the valuation models to actually see if the company is healthy or not. The next thing that we're going to be taking a look at is the cash flow, and more specifically, the free cash flow. Are their operations profitable and actually doing well? So, if we were to look at it for the past 10 years, it does indeed look like there is an upward trend. 2013 to 2018, it kept increasing, and it looks like it almost doubled 62 million to no, it tripled from 2013 to 2018. But then with the pandemic, it looks like it just reset. And now it's starting right back where they left off in 2018, 2019. So, in terms of free cash flow, it does look good. What we are looking for is, does the company have an upward trend or at least a consistent free cash flow? That's what we want to see. And in the case of Texas Roadhouse, it does look like it is going up. This is one of the signs that the company is healthy. Now, an intangible thing that I like to look at is employee satisfaction and a CEO approval rating. Because I've worked in corporate America for 2 different Fortune 20 companies, and I realize how time consuming it is to have employees be turning over left and right. Happy workers mean less budget is allocated to recruiting. So, taking a look at Texas Roadhouse, it looks like the employees gave it a 3.7 out of 5, which seems to be I know this sounds crazy, but 3.7 is actually high for the food industry. Because when you look at some other restaurants and some other fast food places, it is not unusual to see a 1.5 or even a 2 out of 5. The current CEO is Jerry Morgan, and it does indeed look like over 84% of the employees of Texas Roadhouse approve of him and like him. This is a good sign. Next up, we are going to plug Texas Roadhouse into Google Trends to gauge public interest and to see if there are any search trends. Like, are they popular for something? And it looks like there is ebbs and flows, but it is pretty consistent. Now that we have zoomed out to the past 12 months, it looks like people like to really eat out and eat Texas Roadhouse around Christmas and on Valentine's Day. And then what is this? This looks like it's Memorial Day weekend. The Missouri River to the east looks like it's very interested in Texas Roadhouse, but let's see. No, we also have New Mexico, a West Coast, but the majority is the East Coast and the Midwest fans of Texas Roadhouse. Let's see, what are they specifically searching? Texas Roadhouse Veterans Day, 2,250%. Let's see. It looks like a lot of people are searching for a location in their area so that they can eat there. It looks like a lot of people are Googling for the prices of the menus. This is all pretty standard. It looks good. Oh, Manassas. I'm actually from Northern Virginia and I recognize that name. Next up, we are going to take a look at the Investor Relations Annual Report. And I am just going to go ahead and tell you some of the highlights because this is a pretty lengthy document at 188 pages. So Texas Roadhouse opened up restaurant number 700. Can you believe that there's only 700 Texas Roadhouse? Oh my goodness. But anyways, they opened up number 700 in El Paso, Texas back in January 2023. But alongside with that, they have also implemented retail stores within the restaurants because it looks like a lot of people want to buy Texas Roadhouse merchandise. It looks like they took this playbook from Cracker Barrel, who also has a retail shop attached to every restaurant. Smart move, might I say. But other than that, it appeared as if the Texas Roadhouse leadership painted a rosy picture for the future. It looks like they see a lot of bright things coming up. It did not look like they were too concerned with too many headwinds. This is great. And I promise we are going to run the valuation models here in a second. But before we do that, let's take a deeper look at the technical indicators and the stock price movement. So there's a few things that I am looking at here. The stock trading pattern, is it trading upwards, downwards? Is it consistent? Is there a line of support, a line of resistance? And most importantly, what the current relative strength index is, otherwise known as the RSI. So for example, on October 13th, it looks like the RSI was sitting at about 32. And when you look at it from a 12-month picture, it looks as if that is pretty low compared to its past. Now, if you don't know what RSI is, traditionally, a RSI above 70 means the stock is overbought. Below 30 means that the stock has been oversold and it might be a good time to buy. Remember what they say: be greedy when others are fearful, and fearful when others are greedy. So if you look at example in July, his RSI jumped all the way up to 67, 68. But if you look right here, 65, 72. Oh my goodness, 72 RSI. But if you were to back up a little bit, zoom out and look at it from a 5-year picture, it looks like 77 right before the pandemic hit. That's what Texas Roadhouse's RSI was sitting at. And then during the pandemic sell-off, its low was a 29.46. Oh my goodness. That is indicative, because it's less than 30, that it was absolutely oversold. Too many people just sold out of it. And then if you look at it today, what do you know? It's sitting at 31. And that's why on this channel, not only do we look at the balance sheet and run valuation models, we also look at the technical indicators and the intangibles like the employee satisfaction, because all of these pieces of information put together helps to make a more informed and smart decision. But it does look like Texas Roadhouse does have a line of support. Every time that it hits its lower Bollinger Band, it does seem to rebound. But there's absolutely a line of resistance as well. All right, so the moment we have all been waiting for, the valuation models. So jumping to the first valuation model, it's going to be the multiples valuation. So essentially, we're going to be looking at similar companies in the same industry as Texas Roadhouse to derive an intrinsic value based on the PE ratios, but also how does Wall Street value similar companies. So the ones that I picked for Texas Roadhouse, it was actually kind of challenging. I picked Cheesecake Factory, ticker symbol cake, Wingstop, ticker symbol wing, Darden Restaurants, Chipotle Mexican Grill. This right here, some people say it's overhyped, but I honestly love a good Chipotle. Sometimes the line moves really slow, but that's neither here nor there. And last but not least, Cracker Barrel. And some people, when they use the multiples valuation, they take the average of these companies' PE and use that, times it by the earnings per share to derive the stock price. However, if we want a more accurate measurement among numbers when the spread is this wide, the lowest is Cracker Barrel sitting at 15.2, and the highest is Wingstop with an 83.9. That spread is pretty big. So instead of taking the average, we're going to be looking at the median. So taking the median PE and timesing it by Texas Roadhouse's current EPS, we derive at a price of $95. That's the fair price based on the multiples valuation. All right, so jumping on over to the discount cash flow analysis model. What we have right here is forecasting a share price based on the future free cash flow production growth. So looking back the trailing 5 years, we derived at an average growth rate of 46.8%. That sounds ridiculous, right? So when we look at the data, let's see where things went wrong. So looking at Texas Roadhouse pre-pandemic from 2017 to 2018, it looks like Texas Roadhouse had a 58% increase in their free cash flow. That's absurd. And then jumping on over to the COVID era, it went down negative 18% and then also negative 50%. And then when things reopened and we kind of saw what normal looks like again, it surged to 242%. So this right here is going to be a very wonky number. So based on that, I went ahead and took the analyst's estimation for their 5-year growth rate of 18.5%, and I plugged that in over here based on their balance sheet numbers of how much cash and equivalents that they have on hand compared with their total debt, and using those two numbers to subtract from the future free cash flow of Texas Roadhouse from 2023 all the way to 2028 right here. And the number that pumps out from that is the equity value. And from the equity value, we're going to divide that by the current shares outstanding, which gives us the discount cash flow rate price of $153.31 per share. $153.31. It's roughly trading at about $95 plus or minus $4. So to see a stock like that to have the potential to hit 153, that is absurd. But anyways, let's jump on over to the dividend discount model to assess another intrinsic value. So what I did right here is we took the dividend payout per quarter of 30 cents in 2019 times 4 to show the annual dividend of $1.20, and did the same process in 2020, 2021, 2022, and then the current year to determine what the average dividend growth rate is, which is 16.42%, which is really high. Any company that grows their dividend by double digits, that's amazing. Because most mature companies, they only give you like a 3, maybe 5% dividend growth rate year over year. But Texas Roadhouse is a cash machine right now. It is at 16.4%. And honestly, if I were to plug in the 16.4% into the dividend discount model, it's going to give us a skewed number and pump out a share price estimate of like $700. So instead of doing that, I used a number lower than that to be a little conservative to see what would happen, right? So I picked 6.5%. And so if Texas Roadhouse ever makes the decision to slow down their growth rate for their dividends, this is the intrinsic value that we reach, $156.20 per share based on the potential future dividend growth of 6.5%. And I say again, if I were to plug in the 16.42%, this would be a ridiculous number. So this right here is very conservative. 6.5% growth would yield an intrinsic value of $156.20 per share. Now, the last valuation, in my experience, I just call this the bear case, is going to be Benny Graham's valuation model. Now, Benjamin Graham was Warren Buffett's mentor and role model, and he actually derived this really interesting formula that estimates a share price based on its potential growth, but also the current bond yield rate. So looking at Texas Roadhouse, currently has an EPS of 4.33, and its growth rate projection from the analyst is 18.5, and the AAA corporate bonds yield rate right now is 5.4%, because the federal funds rate is actually really high as well, so 5.4. So based on this formula right here and the numbers that we plugged in, we reach a value of $89.97. However, we're not always going to be in an environment where the corporate bond yield is going to be 5.4%, right? The historic average hovers around somewhere between 3 and 3.5%. So going off of that, let's see what happens when things return back to normal. So when the AAA corporate bonds get to 3%, then, according to Benny Graham's valuation model, the share price should be at around $161.94. However, we do want to keep this bear case in mind because we cannot predict the future. So with that said, we will go ahead and rock with the $89.97 from Benny Graham's valuation model. All right, so this is the conclusion. If I have $500, would I buy Texas Roadhouse? So far, so good, right? Everything was a green light. So let's just review what we have. Graham's valuation says, hey, Texas Roadhouse, $89.97. I always think of Graham's valuation as a bear case. Multiples valuation gives Texas Roadhouse a rating of $95.10. The discounted cash flow valuation said, hey, Texas Roadhouse is $153.31. This is almost double this. And then dividend discount model valuation, $156.20. These two are very similar, and these two are very similar. So when we take the average out of those four, this is what Texas Roadhouse should be trading at according to our model valuations. This is the intrinsic value. $123.64. Now, let's take a look at what Wall Street and the analysts have to say. The analysts of Wall Street, if we look at it, it looks like recently they downgraded their price target for Texas Roadhouse. It went from 128 to 121, 110 to 106, 127 to 120. But if we scroll back up, let's see what the consensus analyst price target is, $117.76. So from its current trading price of $92, that's a 27% potential upside. Its low is at a 95. It's below the lowest analyst price target. So based on our calculations, the intrinsic value of Texas Roadhouse is $123.64. Wall Street says that it should be $117.76. So it looks like we're not far off. It looks like we're both pretty much aligned as to where Texas Roadhouse should be. Its current trading price, $92. $92, $123. So let's try to determine by playing with some numbers what should be a good buy price. So based on a 10% margin of safety from its intrinsic value, a good buy price would be $111.28. Right now, it is trading at $92. That gives us a delta of 17.33%. So undervalued. But let's go ahead and plug in a different number. Say you're more conservative and you want to see a lower price before jumping in, 15%. At 15% margin of safety, you would be looking to jump in at $105.10. Currently, it is trading at $92. However, if you want to play it even more safe, let's go ahead and say something like 20%. I always go with 10% being my minimum for my margin of safety. Minimum. But sometimes, based on our preferences and risk profile, 20% is probably more ideal. At a 20% margin of safety, you would be looking to buy Texas Roadhouse when it is at $98.92. Currently, it is at $92. So let's see. If we were to buy it right now at its current trading price, what is the margin of safety that you get with it? Is it going to be 25? You get a 25% margin of safety. So to answer the question at the beginning of the video, if I were to have $500 in hand, would I buy Texas Roadhouse? After reviewing everything, the intangibles, the financials, the technical analysis, and running these model valuations, my answer is yes. However, please do your own due diligence, your own research, and figure out whether or not you want to buy it. And if you like what you saw today, please subscribe, and I will talk to you next time. This is Dividend Compounders with Cheese. Checking out. See ya. Stay safe.